Hi, I'm Kathy. Welcome to Investing in Your Future, the importance of a financial planner. Selecting a certified financial planner is a crucial step in achieving your financial goals and securing your stable future. When choosing a CFP, it's essential to prioritize their certification, ensuring that they can adhere to a strict code of ethics and standards. So stick around and see if you can answer 3 questions about hiring a CFP at the end of the video. Okay. Let's make learning about certified financial planners the coolest thing you do this week. Hiring a financial advisor can offer a multitude of benefits that extends beyond one's financial understanding. First and foremost, a skilled financial advisor provides expert guidance tailored to your individual and unique circumstances and goals. They should possess a deep understanding of these 5 complex financial concepts: investment strategies, insurance, tax implications, estate planning, and retirement planning. All of those things together can be overwhelming for the average person to be able to navigate on their own. But by analyzing their client's financial situation comprehensively, an advisor can develop a personalized roadmap that aligns with their short-term and long-term aspirations, fostering financial security and keeping your peace of mind. Additionally, a financial advisor serves as an accountability partner, encouraging you to stay on track with your financial objectives. This external support can be particularly valuable during times of uncertainty or market volatility, as the advisor's expertise helps to counter emotional decision-making and sometimes impulsive actions. Moreover, financial advisors can help clients optimize their portfolios by diversifying investments, minimizing risk exposure, and then potentially enhancing returns over time. In essence, hiring a financial advisor not only streamlines financial decision-making, but also empowers individuals to make well-informed choices that pave the way for a more stable and prosperous financial future. But how do you choose the best advisor for you? Every person's needs are different. Do you have kids? Do you want to travel? Do you want to leave something for your family after you're gone? Today, I'm going to go over 10 questions that you're going to want to use to ask an advisor to help you choose the best one for you. So think about these 10 questions when choosing your advisor. The first question to ask is, how are you going to get paid? Because there are a few ways that they may collect their fees. They may charge you by the hour, a flat fee, or a percentage of your account. They could charge you based on how much you have invested with them, and then they may reduce their fees the more that your account grows. So if they're charging a 5.1% management fee and you have $500,000 with them, you'll owe $7,500 a year in fees. But you'll gain money by raising your balance to almost, say, $1 million if they're carefully investing your money. Fees can be billed either quarterly or monthly, and they may also add in a fee if you both agree to a performance bonus. In other words, if they hit a certain standard, making you a certain amount of money on their investments. Another way they may charge you is earning commissions when you buy certain funds or products. They earn a percentage based on how much you have invested. So make sure you really need that product or that it's in your best interest for the situation in the market and not just because they're going to earn a profit on it. That kind of advisor may not be working in your best interest, so just be certain that they are. And lastly, they may earn a salary if they're working for a firm that has advisors that work for them. Second question, how are they willing to meet with you? Whether it's virtually or in person, whatever is best for you will be what you're looking for. Ask if they'll also be available for calls and then what their hours are. Number 3, how do they allocate investments? Do they recommend a diversified portfolio that includes a little bit of each type of investment? One maybe has large caps or large companies of over $10 billion in total market cap, or mid caps, which are between $2 and $10 billion, or small caps that have less than $2 billion. Are they suggesting international securities, companies that are listed on international exchanges, or emerging markets? These are issued by companies in developing nations. They also might suggest fixed income securities, which are highly rated corporate or government bonds that pay a set amount of interest each year. They might suggest money market investments, which are short-term debt. And finally, they might suggest REITs, which are real estate investment trusts, where you put your investment into a pool of mortgages or other properties. Because what you're really looking for is for them to minimize the risk while maximizing your return. Different assets have different risks associated with them. So the more return you're looking for, you're probably willing to take more risk. Another consideration in investing is asking yourself, how soon do I need this money? If you're going to need it within the next 5 years, you'll probably want to choose a less risky portfolio. The fourth question is, are you a fiduciary? This means that your advisor will have to act in your best interest. They'll do this by managing your money and property carefully, worrying you only when making choices for your portfolio. That way they'll keep you and your heirs in mind, offering products or services that will benefit you, not ones that will make them money. Number 5 asks, what are your qualifications? You should expect them to have at least a bachelor's degree in finance, marketing, or business, and be able to sell securities, which are stocks and bonds. They'll need to have passed the General Securities Representative License, called a Series 7 license. It covers all the basic investment knowledge and the regulations around selling them. A Series 63 license, called a Uniform Securities Agent State License, will allow them to sell across many different states. Finally, the Series 65 license covers the Financial Industry Regulatory Authority, and it's for the advisors who charge an advisory fee. A certified financial planner has to pass the CFP exam to be able to use that designation. They're tested on their ability and aptitude for a comprehensive, holistic approach to financial planning. They really do work for your best interest. Number 6 asks, what are all of your costs? This question is meant to make sure that there are no hidden fees, that you are made aware of each and every possible charge that they might pass on to you, because fees can eat at your savings without you even knowing it. Question number 7, do they work within your investment philosophy? This question really seems unnecessary if they're fiduciaries, because they need to respect your style of investing and follow your guidance, but they should also be able to share with you what options you have. Instead, I would ask, do you provide education? In other words, do they honor that you're still trying to understand how all of this is going to impact you, and are they willing to slow down and explain what it is that they're doing for you? This is actually another great reason to get a certified financial planner, because they will create a full document explaining why they're suggesting what they're suggesting to you, options with any class of investing, and how it will affect your taxes, what insurance you'll need, and then finally how it's going to affect your retirement and estate planning. They really are a worthwhile relationship to have. Question number 8 asks, how do they benchmark their success? They should be able to explain how they're measuring success in all areas of your investments, and not just against the S&P 500, because that's only measuring large cap investments. They should be comparing how they're doing to whatever the benchmark is for that certain security. So for example, if you're invested in international securities, they should have a benchmark that they're working to beat with your investment strategy in mind. The 9th question to ask is, who is your custodian? This is the company that will be actually holding your money and investments. You're going to want to hear that they've hired an independent custodian to hold your investments, and they should be able to tell you how your investments are doing and be able to show you immediately if requested. The custodian needs to be a broker-dealer, a bank, or another qualified custody, according to the Securities Exchange Commission, or SEC. The website at sec.gov has a great deal of information on investor protection and the regulations for security markets. It is not an easy read, but it is very thorough. And finally, question number 10. What are the tax implications of investing with you? Ideally, they're qualified to have your return prepared for you, but they still need to be able to sit down with you and explain how they're going to minimize your tax liability and save you the most money on your taxes. They should know that your financial goals are and what your unique situations are. It's okay if they lead you toward a separate tax professional, but you should know what you're going to owe before taxes are due and what their advice will mean for you, so that you'll know what you'll owe at tax time. I can't emphasize enough that you're going to want to both get an education and have a relationship with whomever you're choosing to invest your money with. You need to understand how all of your assets are working for you and how it's going to affect you and your retirement future. There is no dumb question, so be sure and ask whatever you have for them. Now, the 3 questions for you to answer. What does being a fiduciary mean? What are the 5 big areas that a CFP will guide you through? And what are the different ways a fiduciary may be paid? This has been Kathy. Thanks for joining me on your journey to financial empowerment. If you're new here, please subscribe so that you can change the way that you think about your relationship with money.